Gilded was founded by our CEO, Ashraf Rizvi, we call him Riz, because he really felt that we have an issue in the world with fiat money. And, a lot of people think this. We've got, inflation, we have money printing, we've got credit exposure in a way, and geopolitical risks now. And so there are lots of reasons people are looking for alternatives to fiat. I mean, crypto is just one. You see people putting money in various places right now. But gold is really a traditional store of value, and it always has been. And so, what Gilded is doing is trying to improve on fiat money by using a historical store of value, which is physical gold, but improving on it by making it digital. And what that means is we're making it a lot easier to purchase and store and sell your gold eventually than traditional physical methods. You still have the direct ownership of the gold bar. It is your property. It is sitting in a vault that you own. It is your title. It is your property. That is different from a lot of other types of stable coins or other kind of crypto style investments.
Today's markets are really challenging. We don't need to talk about global geopolitical risk. What's going on in the Ukraine and Russia is one thing, but it spills on to energy usage in Europe and the economies, the big economies of Germany and Western Europe. It spills on to Iran, what's going on with North Korea. It extends, its tentacles extends far and wide, and the implications are really unknowables. The other thing that's going on in the world right now is governments are just printing money at an unprecedented rate. And if we go back and just look at the United States, and this is true for all of the developed world as well, but the United States in 2006 had a debt to GDP ratio of about 60%. 15 years later, it's 130%. Tremendous increase over a number of years. A similar pattern with the Federal Reserve balance sheet. Before the financial crisis in 2006, the Federal Reserve's balance sheet was less than $1 trillion. And right now it's sitting at about $8 trillion. What a tremendous multiple of increase in money that's out in the system. So there's a response for this. And so it shouldn't be surprising that inflation levels are higher than they've been for 40, 50 years. So that's in front of mind right now for most of our investors, our clients. They're thinking about inflation, but inflation's always a problem, and it's a structural thing. Right now, the alternatives to inflation are the thing that become a challenge. So if we think about what we can do as advisors, well, we can point our clients to real property. Art, wine, collectibles, real estate, physical gold. The problems with real estate, art, and wine, Picasso, it's challenging to generate liquidity. Once you're involved in a property, real estate, it's not so easy to generate liquidity on a short-term basis. And what Gilded is doing is allowing for liquidity to be generated with physical gold without having to have a tax event to sell the gold. What about equities? Well, when you have geopolitical risk, when you have valuations for equities that actually are at very high historical levels. So if we look at Robert Shiller from Yale, he has the CASE index, the cyclically adjusted PE ratio, where you take a 10-year PE ratio, moving average, and you look at the valuation of the equity market on that basis. He's tracked it since 1871, and it's only been higher one time in that history. The internet bubble. So today is the second highest. So even with the correction that we faced, equities are still very fully valued. So it's tough to be advising your clients to weight their portfolio even more towards equities in this environment. And then tips, bonds in particular, real yields negative today. The 10-year real yield just tweaked over to the positive side, but they've been hovering around negative rates, and tips are not that much better. And it's not clear that a 3% inflation break even makes sense right now. So asset markets are rich. There are few alternatives, whether they're bonds or equities or property, that offer the kind of thing that will get investors the safety from inflation that they're looking for. So what we're trying to do at Gilded is offer an alternative to that. And we think that gold has served that alternative in a number of ways. And let me just list them for you. First of all, gold has compelling returns historically. So if we go back from 1971, the year that Richard Nixon decoupled the US dollar from gold, and we look at returns since then, gold's returned about 8% since 1971 when it came off the gold standard. Now, equities over that time has returned about 11%. So gold has really held its own in that period. But if you look at the period from 2000, the introduction of the euro, to today, gold's returned 8.6% and equities have only returned 7.5%. Let me repeat that. Gold has outperformed equities since the dawn of the millennium. Professional investors look at me and tell me I'm wrong all the time, but I promise you, go to Bloomberg, take a look at the data, and you will see that gold has actually outperformed equities. Now, I want to emphasize, Gilded is not here to tell you to reallocate from an equity portfolio or an alternatives portfolio into gold. What we are suggesting is that for your clients that are holding too much cash, this is the right alternative. So physical gold is actual property. It's your title, it's your client's title, it's their ownership. It's not a financial asset that has to be managed. For example, a gold company, gold mining company. There's a manager, CEO is deciding where to drill the holes. Will they pan out? Will there be as much gold there as they hoped? Will they pay their employees too much? Will they take on too much debt? Will they manage their company properly? Similarly, ETFs, they're managed instruments. They're financial pools of assets with managers. They are not physical property. So physical property has the benefit of being bankruptcy remote, and you can store it outside the banking system. So even with shares of stock, you've got to store those with a brokerage firm, and sometimes brokerage firms have problems.
When you purchase gold from Gilded, we purchase gold directly from one of the 4 big Swiss refiners. And we have that gold shipped to a Brinks vault. And we have a network of Brinks vaults around the world, but for the sake of argument here, we'll say it's in Zurich. So you would purchase gold. We do that. The pricing is at the fixing price, the LBMA fixing price, which happens twice a day. So it's a very transparent mid-market price. We do add a margin to that for our efforts, but you own the gold, you buy it from the Swiss refiner, it is stored on your behalf in a Brinks vault. It's not our gold, it's your gold, it's your title, it's your property, but it's much easier to purchase it that way than historical ways. We keep a blockchain record, which is an immutable record. It is a ledger that records the ownership of that gold bar. And furthermore, we will provide a picture of that gold bar to you. So on your phone, you will be able to see a picture of the gold bar that you just purchased. The gold bars come in increments of 100 grams. 100 grams is roughly about $7,000 worth of gold. That's one of the reasons Ray had discussed earlier how we've moved away from the retail and more in the institutional space. That's one reason, is the minimum size is a 100 gram bar. But we also sell kilogram bars or even 12.5 kilogram bar, which is worth $800,000 or something. So we are, enabling the purchase of physical gold. But more important than that, once that gold is held digitally, the gold can be used in a way that makes it much more usable than a gold bar, a brick in a box or a paperweight. It suddenly becomes not just a store of value, but a medium of exchange. That gold can be pledged. It can be used as collateral. It can be used to transform an asset that you own into liquidity. And you can do that without having to sell the gold bar. If you want to sell the gold bar, you can. The wash rule in the US says that you cannot simultaneously sell an asset and buy it back, or sell a security and buy it back to lock in a tax loss. You have to wait 30 days. Gold is actually it's a physical commodity. It's property. You can sell a gold bar and buy another gold bar. So if you wanted to sell your gold holding to lock in a tax loss, you could. But assuming that gold goes up over time, you may want to have liquidity from your gold, but you don't want to sell it and have a taxable event. So what you do instead is you would pledge it. You would pledge it as collateral. And there are institutions that love taking gold as collateral. It's one word for it. It's called right way risk. Try saying that 10 times. Right way risk. Right way risk means that when the world is going to hell, the asset you're holding, you also don't want going to hell as well. Gold tends to be negatively correlated in risk on events or down events. So it's right way risk. It's good collateral. And many institutions are willing to loan 80 or 90% against gold so that you're able to monetize it fairly easily. Now, a security, because of Reg T, the most you can borrow against a security is 50%. So, you know, for the purposes of needing liquidity, traditionally gold is very hard to acquire and then to use as collateral. But when it's been digitized and you have a digital ownership record, and an institution will take that record and considers it as good as the gold bar itself, then you're able to monetize it. And that's what Gilded is doing in a nutshell.
This is a thing that I think a lot of experienced investors are sometimes surprised by, which is some of the misperceptions around ETFs. Now, ETFs, I'm not here to say that they're not a fantastic product. They're incredibly profitable for BlackRock and State Street. They are really useful for short-term exposure to the price movements of gold. So if you have clients that want to have some short-term exposure, these instruments are fantastic. But there's some misperceptions. When you buy an ETF, you don't own gold. You don't own gold. You own shares in a fund, and the fund is managed by a trustee, and the trustee has a custodian, and the custodian has a sub-custodian. Delivery is not guaranteed. There are mechanisms provided for delivery to make it possible, but there's lots of wiggle room. The only way to find out these things is to really go through the prospectus. And unlike property, which doesn't require a prospectus, a fund does. Funds are not insured. You don't have control over taxes. And if you're going to hold it for the long term, the ETFs are really clear about this. Your holdings will be reduced over time to pay for the fees of the fund. So you won't be able to maintain long-term exposure unless you actively go out and buy more shares of the ETF, because your holdings will be reduced over time. So there's some real fine print that even sophisticated investors sometimes haven't had the chance to really delve into the details of the prospectus. But for intergenerational wealth, for people that are saving for a really long term, physical gold is superior with the trade-offs that Arthur mentioned. It's hard to generate liquidity, and it's hard to make that argument that you can reduce cash, but Gilded's been working to solve that problem.